Okay, let's take a look at chapter 21. And for those of you keeping score, this is it. That's it. The end of the road. Chapter 21, closing the transaction. This is it. This is it. So this chapter is almost exclusively a math experience because we are going to learn how to calculate the amount of funds that a buyer would need to close a transaction and the amount of funds a seller would take away from a transaction. So basically it's learning how the math of a residential closing works. But before we get to the math pieces, let's talk about a couple of the laws that are in place that deal with closing the transaction. First of all, the Dodd-Frank Act is a federal law. It created the Consumer Finance Protection Bureau, and it's there to regulate lenders. It's a lender regulation law. It's a consumer protection law. It's there to protect consumers from lenders. And we see the effects of it if you open a credit card statement. You know, if you open your credit card statement now and it says if you only make the minimum payment, it'll take you like 342 years to pay it off and you'll pay $6 million in interest or whatever it is. That is a result of the Consumer Finance Protection Bureau. That panel is mandated to be there because of the Dodd-Frank Act and the Consumer Finance Protection Bureau, just as an example. But it's a lender regulation. The laws that we really care about in real estate closings are Respa, which stands for Real Estate Settlement Procedures Act. Respa stands for the Real Estate Settlement Procedures Act. And Respa is in effect anytime there's a loan involved in the transaction. The reason the federal government can regulate these transactions is because ultimately who's going to buy all of these loans? Fannie Mae. And Fannie Mae can borrow money directly from where to buy them? From the federal government. So, since ultimately federal government funds could potentially be used to purchase these loans, they get to have some say in the closing process for these loans. And that's where RESPA comes from, the Real Estate Settlement Procedures Act. And it's just a law that governs exactly how these closings work, how the money changes hand at the closing, and how we document that money changing hands at closing. Another law that we deal with in real estate transactions is TILA, the Truth in Lending Act. The Truth in Lending Act is a disclosure act. Remember we talked about earlier today Regulation Z of the Truth in Lending Act, and we're going to go over that again. Always disclose what's going on with the loan. That's the basis of the Truth in Lending Act. And both of these together govern how we do closings. Again, Respa is in play. Respa is in effect anytime we have a loan. The rule says a federally related loan, but since Fannie Mae can end up buying pretty much any loan, they're all federally related. So anytime there's a loan in the transaction, then we have to follow the rules of Respa. These are the two things you need to know about Respa. Right here. These two bullet points right here are going to be the big ones for you guys on a test. Respa requires two things to happen relating to that loan. There are a lot of other little smaller rules, but these are the two big ones from your perspective. Number one, the borrower has to get an estimate of what that loan is going to cost them within 3 days after they apply for the loan. Has everybody got that? So 3 days after the borrower applies for the loan, which is a long time before we get to closing. Does everybody understand that, right? You apply for the loan long before you get to closing. You may apply for the loan even before you go under contract on the property in a lot of cases. So within 3 days after you apply for the loan, you are required to get what's called a loan estimate. It's an estimate of all the costs associated with that loan. So discount points, origination fees, interest rate, monthly payments, all those things have to be estimated, and that estimate has to get to the borrower within 3 days of loan application. And then at least 3 days before closing, the borrower has to get a final worksheet, a closing statement that shows what those charges actually were. Think of an estimate. If you go get an estimate to get your car worked on, when you get the final bill, what do? You compare it back to the estimate. That's the idea here. The idea is that the borrower is supposed to be able to compare what they were actually charged to the estimate. And ideally, they should what? They should match. And there are rules that go into what happens if they don't match. But the things you need to be aware of for test taking purposes is to get the loan estimate how many days after loan application? No later than 3 days. And they have to get a closing disclosure no later than what? 3 days prior to closing. Good. We have now combined the rules of Respa and the Truth in Lending Act into what we call TRID. TRID is an acronym of acronyms. Only the federal government can get away with doing that. The TILA Respa Integrated Disclosure. If you wanted to say the whole name, it would be the Truth in Lending Act, Real Estate Settlement Procedures Act Integrated Disclosure. That's what those 4 letters of TRID stand for. And you have to know all that for the test, but I'm just kidding. You don't have to know all that. But basically, it did make our lives much simpler because these used to be separate forms and separate laws and separate disclosures, and they basically said the same thing. Now they've been streamlined and integrated with one another, so you have one document that does it all versus 2 in the past. Okay. Now, as far as what we are responsible for on the closing statement itself, as brokers in North Carolina, you are responsible for verifying the charges and the credits that you can verify. Not all of them. Do you think they might try to throw you off on a test by putting the word all in a statement? Like saying the working with real estate agents brochure is appropriate for use in all transactions. Do they do that? And is it a correct statement? No, because it's not appropriate for use in what kind of transactions? In what kind? Leases. The working with real estate agents brochure is not appropriate for use in leases. So it's not appropriate to say all transactions. The same thing is true here. We are not responsible for verifying all charges on that closing statement because the truth is there are going to be some things we can't verify. A lot of these lender-based charges, like the title insurance, we have no idea how to verify that. We just have to take for their word, it is what it says it is. But what are the kinds of things that we could verify on a closing statement? Commission, yeah, that's usually the first place we look, honestly. That is for me anyway. What else? Property taxes. Are the property taxes prorated correctly between the parties? What else? Sales price. So seller credits, if we've got any credits. How about earnest money deposit, due diligence fee, all those things that show up on the contract. Can we verify excise taxes? Yep. Make sure they are the correct amount and charged to the correct party and all that good stuff? Absolutely. So there are going to be plenty of things that we can verify. Now, I passed out, and I only gave you one. We'll give you some more. Leslie's making some more copies. But don't get too used to this thing because you're not going to have it on the exam. That sheet that I passed out, this is training wheels. You have to get used to not having it, though. I don't mind you using it for the first few times you do this, but you're not going to have it. The good news is, how many columns are there? 4. If you can't draw 4 columns, you're in trouble, right? You don't need this sheet in order to answer these questions. What you need to realize is that there are going to be debits and credits for both parties in the transaction. Are we taking that money from them or are we giving that money to them? The art of doing a closing statement is knowing what things are debits for which party and credits for which party, and vice versa. Does that make sense for everybody? So right now what I would like to do is go through these so that you can make marks on your sheet that you've got there or somewhere else, and obviously you have the slides as well, about which column these charges or credits go in. Who do they belong to? Is it a charge? Is it a credit? Is everybody good with that? So the first one we've got up here, the sales price. What do you notice about the sales price?
It's the buyers.
How many columns is it in?
Just about two.
It's in 2. Because we're taking that money from the buyer, but what are we doing with it? Giving it to the seller. So it's a debit or a charge to the buyer and a credit to the seller. It goes on there twice. Charge buyer, credit seller. Does everybody see that? Look at the due diligence fee. How many columns is it in? 2. Who paid this money? Who paid it? Not who was paid, but who paid it? The buyer paid it. And we said all along it was going to be part of the purchase price, right? So the only way it can be part of the purchase price is if we give them, fill in the blank. Give them blank for it. Give them credit for it. We have to give them credit for having already paid it. So what is it going to be in the buyer's column? A buyer credit. Well, guess what? It's part of the purchase price that's already been paid in advance to the seller. So what do we need to do with it from the seller's perspective? Take it back from them. You take the due diligence fee back from them. Because if you didn't, folks, they'd have too much money. Think about it. If you're selling your house for $100,000, right? And the buyer pays you a $1,000 due diligence fee when you go under contract. When we get to closing, we're not going to put $99,000 up here as a sales price. What are we going to put? $100,000. So if we just gave you credit for the whole purchase price and you've already got $1,000 in your pocket, how much money would you end up with? 101, wouldn't you? So what do we need to do with that due diligence fee? Take it back. It's got to come back out. So for the due diligence fee, we give the buyer credit for it, but we charge the seller for it. You notice a trend with a lot of these things? They're opposites, right? If it's a debit for the seller, it's a credit for the buyer, and vice versa. We good so far? Purchase price, due diligence fee. You have to memorize these things, okay? Which way this money's flowing. The third one there, the earnest money deposit. Well, we need to give the buyer credit for it. Does everybody agree with that? Because they paid it. Here's the thing, though. Who did they pay it to? The escrow account. Did the seller ever touch this money? So does it impact the seller at all? So do we do anything on the seller's side with it? No. Nothing on the seller's side. Earnest money is a buyer-only entry. The new mortgage loan. Now this is one you're going to have to wrap your head around a little bit. A lot of people want to think of a loan as a debit. What is the bank actually doing on the day of closing, though? They're giving you the money. It's a credit. That new loan you're taking out, that's a credit to the buyer. Now we get to the good stuff. Commissions. Who's paying them? The seller. So that's a seller debit. And by the way, any of you that have accounting experience, debits and credits are opposite on this thing. And I know it is. It's tough for people who have accounting backgrounds. This is more like an ATM card, debit and credit type thing. Okay? Excise taxes, who pays them? The seller. Seller debit. Loan expenses, so origination fees, discount points, anything relating to that new mortgage loan. Whose new mortgage loan would it be? The buyer, so that's going to be a buyer expense or debit. A buyer charge, debit. Continuing on here. Now, we get to the one that people get the most confused with, I think, property taxes. Okay? I'm going to show you a tool for doing the property taxes, but for right now I just want to explain it to you. I'll show you my little trick for handling it in just a minute, okay? Property taxes come in two varieties on a closing statement. They either have already been paid, and if they've already been paid, who would have paid them already? The seller. Or they will be paid later in the year, and if they're going to be paid later in the year, who's going to pay them? The buyer. The best way I know of to explain this is you do the opposite of what's happening outside of closing. So if the seller has already paid outside of closing, who needs to pay at closing? The buyer. If the buyer is going to pay later in the year outside of closing, who needs to pay at closing? The seller. Does that make sense? You do the opposite. Now we're going to talk about what part of the year and all that in just a second. Don't even try to absorb that part yet. But just understand that we're doing the opposite of what's happening outside of the closing. And you notice it's in how many columns? 2 columns. What we're saying here is if the taxes have already been paid by the seller before closing, then that entry is going to be a credit to the seller and a charge to the buyer. Because I said, if the seller paid outside of closing, who are we charging at closing? The buyer. And if we take it from the buyer, guess who we have to give it to? The seller, because the seller paid the whole bill. So they need to get reimbursed. The next one is the opposite example. If the buyer is paying the tax bill later in the year, they're paying the whole tax bill. So if the buyer's paying outside of closing, who's paying at closing? The seller. And if we're charging the seller, what are we doing with that money? Crediting it to the buyer. Now, here's where I'm going to threaten your livelihood right here. If I walk around and I look at you doing one of these, and I see 2 different numbers for a property tax, I'm going to hit you with my shoe. I am. I swear I am. These have to be the same numbers. Don't split the year up and put one number in the buyer's column and a different number in the seller's column. It's always the same number in each column. Because whatever you're charging the seller, you're crediting the buyer. Whatever you're charging the buyer, you're crediting the seller. Does that make sense? So it's one amount of money. It's not 2 different ones. I'm sorry? It has to balance. That's exactly right. They need to balance each other out. Is everybody okay with that? And I'm going to show you the trick on how to pick the part of the year you're prorating in just a second. But conceptually, are we okay so far? Good. Okay. Recording expenses, those could be either party. The buyer could have some recording expenses. The seller could have some recording expenses. We're talking about paying to record those documents at the county courthouse. Either one of them could be paying for that. And that's why you see it show up in both columns here. You're just going to follow what it says. If it says the seller, we're paying, $25 to record the seller's satisfaction, well, who's going to pay for that? The seller's satisfaction. Who would pay for that? The seller. If we're paying $45 to record the deed of trust, well, whose new loan needs a deed of trust? The buyer. So that'd be a buyer expense. So it's pretty clear who those expenses go to, and you just put them in the correct column. The attorney's fees are always going to be paid by the buyer. Homeowner's insurance and taxes for the escrows would be buyer expenses. So if they say that the homeowner's insurance premium for the year has to be paid at closing, that's a buyer expense. And then they may also want you to escrow some months of homeowner's insurance and taxes. That's also going to be a buyer expense. We have to jumpstart those escrow accounts. And then you just total up the columns. You total up the seller charges. You total up the buyer charge. You just total each column. And simple subtraction will give you how much money each party is dealing with at closing. And for the buyer, it's going to be cash due at closing. For the seller, it's going to be cash that they take away from closing. Does that make sense? Good with this? Okay, so let's look at some examples of the math that you're going to have to do. Loan amounts. We've dealt with this before. New loan amounts are almost always going to be given as a loan-to-value ratio. So how are you going to calculate the loan amount? Sales price by the loan-to-value ratio would give you the loan amount. Remember this. Discount points, origination fees, all those are loan expenses, right? If you're charging 2 discount points, that's 2% of the loan amount. Make sure you're using the loan amount to calculate the loan expenses, not the sales price. Interim interest. We've talked about this, have we not? What do we say interim interest was? It's interest from day of closing until the end of the month, right? And we've got an example right here. Jason's obtaining a 30-year fixed rate, 4.5% mortgage loan for $185,000, closing on May 22nd. So we calculate the yearly interest by multiplying his loan amount times that 4.5%, and then we divide that by 360 to get the daily interest of 23.13 a day here. And then there are 9 days from the 22nd through the 30th. 22, 23, 24, 25, 26, 27, 28, 29, 30. 9 days. So that's 9 days worth of interest, and that would be a buyer debit. The interim interest is a buyer debit. Origination fees and discount points. They're just a percentage of the loan amount. So a 1% origination fee is going to be 1% of the loan amount. 3 discount points, 3% of the loan amount. And again, whose column is this going to go in? Buyer, debit or credit? Debit. Buyer, debit. Exactly. Excise taxes. How do we calculate them? Sales price divided by 500 as a whole dollar. And who pays them? The seller. This is a seller debit. Escrow accounts. A lot of times they'll tell you we need to escrow a certain number of months of property taxes or a certain number of months of homeowners insurance. Well, when we're escrowing property taxes, they usually give you the annual property tax bill. Talk to me about an escrow payment. What's happening with an escrow payment? What are you doing? How often are you paying it? Monthly. So if they wanted you to escrow 3 months worth of property taxes, what would you need to do?
Figure out what the monthly was.
Get the monthly by taking the annual and dividing by 12 to get the monthly tax bill, and then multiply that times 3. And all of the escrows are going to be buyer debits. All those things are going to show up as buyer debits. So in this example, it says Scotty's purchasing a home with annual property taxes of $6,540, and her lender's requiring her to place 7 months of taxes in escrow. So we take that $6,540, divide it by 12, that's $545 a month in property taxes, times 7 months, $3,815 in property tax escrows, and that's a buyer debit. So now let's get to the one where we have to think a little bit. Again, here are 2 situations. The property taxes have not been paid. If they've not been paid, who's going to pay them later in the year? The buyer. If they have been paid, who's going to pay them later in the year? I mean, who has paid already? The seller. And we're just going to do the opposite on the closing. So here's what I want you to do. Let me X out of here real quick. I think this is probably the best way to get the dates correct. This also takes care of who owns the day of closing, because the seller owns the day of closing anytime you're prorating something between the 2 parties. So, for example, if we say that the property taxes are $3,600 for the year. And we are closing June 12th. And we want to do that property tax proration. Here's what I want you to write down on every single one of them. Seller owes January 1 through, and it's always going to be the closing date. And then you're going to write buyer owes. And what date am I going to put?
6/13 to 12/31.
June 13 through December 30th. I want you to write that every single time. Because the seller always owes from January 1 through the closing date. And the buyer always owes from day after closing through the end of the year. Can everybody do that?
Yes.
Now all you got to do is figure out which one to circle. Now you only have to figure out which one to circle. So, closing on June 12th. Have the taxes been paid? No. And how do we know that, Robin? Because they're not due, but that's not how we know they haven't been paid. We know they haven't been paid because they haven't even been what? Issued. The bill hasn't even come. When does the bill come out for property taxes? September. So a June closing, there's no way the taxes have been paid. Is everybody with me on that? So, who's going to pay them later in the year? The buyer is going to pay them. And what did I say we need to do at closing? The opposite, right? Who's paying later in the year? Who's paying outside of closing? The buyer. So at closing, we need to do what? The opposite, which means we need to do the seller's piece. That's our proration right there. And it tells us everything we need to know about the proration. Because it tells us who we're debiting, who we're going to be debiting. Just look at what's circled. We're going to debit the seller. And we're going to debit the seller for what period of time? January 1 through the 12th of June. And if we debit the seller, what do we automatically do? Credit the buyer for the same amount of money. Yes, sir, Celine.
The way to look at it after we do it, like you said, we write this down every time. Couldn't you clearly see, like, anything happened before June 13th belong to the seller?
Sure.
That's the way to look at it.
Sure, absolutely. Okay. Does everybody understand that so far? So we know that's going to be on our closing statement. We know it's going to show up as seller debit, buyer credit. Whatever amount of money we come up with, that's how it's going to be entered. It's going to be in those two columns, in the seller debit column and the buyer credit column. Just by circling it. We know the proration. Yes, ma'am.
I don't know, this might be a stupid question, but how do you know if something is, if you're going to debit something or you're going to credit something? Or do you just have to memorize it?
You have to memorize it largely. You have to memorize it largely. What is a debit? Am I taking money from you or am I giving it to you? That's exactly right. And what is a credit? That's exactly right. So, what you need to ask yourself is, are these things we're talking about, are they things that we would be giving this person money for, or we would be taking money away from them for? So, like the purchase price. Are we taking the purchase price away from the buyer, or are we giving it to the buyer? So, it's a buyer what? What are we doing with the seller as far as the purchase price? Giving it to him, so it's a seller. There you go. Okay? So, now we need to prorate from January 1 through June 12th. Is everybody with me on that? So, what we can do is go ahead and figure out the number of days there are from January 1 through June 12th. You can do it one of two ways. You can figure the number of months and multiply that times 30, or you can just count the number of months. I don't care. Some people sit there and literally write down 30 plus 30, plus 30. That's March, April, May, plus 12 days in June. I don't care how you get there. Okay? But how many full months do you have? 5, right? January, February, March, April, May, 5 full months, and then just a portion of June. Just a portion of June. How many days in June? 12. So that looks like 162 days to me. Right? 5 times 30 would be 150 plus 12 is 162. 162 days. So what do we need to know? The daily rate. Well, we go back to $3,600 a year. $3,600 per year divided by 360 days. That equals what, $10 a day? Times 162 days. $1,620. And again, we're going to do what with that?
Debit to the seller.
Debit who?
Seller.
Debit who?
Seller debit.
Who we debiting wrong? Seller. And credit buyer. Remember, that's the whole reason we circled it up at the top. We don't want to mess up now. I mean, that's why you do the circling before you start doing the math, because you start doing the math, you're going to get wandered off in the wilderness somewhere and forget which way you're going. If you write it down and circle it from the beginning, you cannot possibly do it wrong unless you're literally not doing what you circled. Because it clearly says seller what? Owes. Well, damn, y'all. Don't get much more descriptive than that, right? That's a debit. That's what I'm saying. Silly things like this help a lot in something like a closing statement because you're doing so many steps, you need a reminder. Seller pays. That's a debit. Okay?
So on the day of closing, though, so how do you differentiate the days on closing?
How do you differentiate it?
So it's going to say seller owes, that's it.
No, it's not.
No,
What did I write down? Who paid for the day of closing?
Oh, the seller.
That's it.
Okay.
You got it. That's all the differentiation you need right there. The seller pays for the day of closing. Anytime you're splitting something between the two of them. Now, there is one charge that the buyer pays for the day of closing, but that's because you're not splitting it with the seller. Remember interim interest from the day of closing through the end of the month? But that's not being split with the seller. Anytime you're splitting a charge between them. And so what other things can we split? HOA dues, property taxes. How about rent? If rent has been paid on the property, will we need to prorate that out? Absolutely. Absolutely. But anytime you're prorating between the two of them, the seller owns the day of closing. Okay? So I gave you a couple examples here of the differences between the two. It says this one, the closing is on July 18th and annual property taxes have not yet been paid. So I would write down, again, seller owes January 1 through what? July 18th. Buyer owes July 19th through December 30th. And in this case, it says they've not been paid and buyer will pay in full later in the year. So who are we circling? If the buyer's paying outside of closing, who are we circling? We're circling the seller. So that means we would be prorating from January 1 through July what? 18th, which is 198 days. We take our annual property tax bill of $43.80. Divide that by 360, and that's $12.17 per day. And then we multiply that times the 198 days, and that's our prorated amount of $2,409.66. And that's going to be entered as, we said we circled seller owes, so seller what? Seller debit, and if it's a seller debit, it must be a buyer credit. Everybody understand how that works? All right? Why don't you work on this? Now, obviously, you have the answers on the next slide. But I want you to take a few minutes, and I'm going to wander around.